Starting. All attendees are in listen-only mode.
Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending December 12th, 2014. Certainly an interesting few weeks that we've got, or that we've had. Most of our members already know that we were expecting a little bit of a pullback. We just didn't know how much. What you see on the screen here on the right side is the SPX cash index for the S&P 500. Let me just zoom out a little bit. I want to show you a little bit about what how this thing is constructed here to give you some perspective. And I'm going to come back all the way to 2009. And as you see on here in the SPX cash index here, starting back in 2009, we've had this channel that's been running very nicely, and it's honored this channel very tightly. You can see right back in this area right here. As we've run up, you can see this yellow line here is the 200 EMA. But you can see that we've tested and found support at the 200 EMA very nicely, and we haven't really tested the bottom part of that channel going all the way back until 2010. And as you can see, we've also tested it a number of times in the upper boundary. So we've been kind of center upper quadrant of this channel. And then starting right in this area here, which is 2011, there is another channel that I drew, which kind of showed you a little bit about the, we've never really have been able to penetrate the northern part of the channel, but the channel actually got tighter starting in 2011. So that means it's been a very tight range, and the range has kept us in the upper quadrant of the boundary here. In fact, looking at this channel, again, that's back in 2009, you can see the width of the channel. We've had a pretty wide extreme movement from the high to the low of the channel. But then starting in 2011, the channel narrowed, and you can see I've got that narrower channel there. And then since 2011, we've honored that narrow channel all the way up until we had the October break right here. But then this outer boundary provided the stopgap support. Now, looking down here at the RSI indicator, you can see here the 50 line is the, anything above 50, the markets are grinding higher. Anything below 50, or as it's moving below 50, the markets are grinding lower. And you can see at this point right now, we are not in an oversold condition, not like we got in October. And that's important because this down move can continue on for a while. You can see right there in October, we got a little bit oversold. But on a daily basis, going all the way back to 2011, there's only just been a couple of minor instances since we've, you can classify the market as being an oversold market. And each of those times, we never really got south of the southern border of this upsloping channel, except right there in October, we actually broke it, but we never got beyond the southern border of the outer channel. So we're going to use the same logic going forward, and we're going to make the assumption that longer term the bullish run is still intact. However, we are in a sell on any rally kind of condition now. So let me just zoom in, keeping the same daily chart so that you can see what I'm referring to here, and just exactly what I mean. And our members that have been following along with me understand that this should not be a surprise to anybody with this pullback. Now, the severity of the pullback, no one really knows until you get into it. But just a few days ago, I told our members we are now in, because we didn't know if we were going to be a buy on a dip or sell on the rally kind of mentality. We shifted over to a sell on any rally mode a few days ago. And it's worked out very well for us. Now, you can see this is the chart, or the blow up of the SPX, and you can see both of the bottom channels, one, the tighter channel that we got into starting in 2011, that would be that upsloping and that upsloping line right there. That's the tighter channel. And as you can see, we blew through it in that October pullback, and we never really did. I mean, intraday, we moved beyond the outer channel, but we basically closed. You can see those long tails there. We closed up above, and it was a really hard bounce. And you can see here when we blow it up, we actually were in an oversold condition there, but we're not on the RSI here. So that tells me that we could still have more downside action. The other thing that I'm looking at is this Elliott wave pattern here. You can see an Elliott wave 3, which tends to be the longer running leg, and then there the stronger impulse move. And then you can see an Elliott wave 4 starting to form in this area here. Here's the 50 EMA right here on the SPX. And you can see the 50 EMA now on the SPX is sitting right around 2002. In fact, the SPX closed Friday at 2002.33, and the 50 EMA is sitting just about right on it. So that's where we're located right now. And you can see the projections of an Elliott wave 4, and I would say very likely that it takes us to the bottom of this channel. I mean, that to me is a very highly likely event. That's the 200 EMA also sitting at the bottom of that channel. That would put us around anywhere between 2060 and 2041. Now, we've had a couple of really hard down days, and you can see these green candles at any attempt on a rally has been met by these big red candles, which means we've been selling on the on any rally. And right in that area there is when I shifted our members from a buy on the dip to a sell on a rally kind of proposition. Okay, and this is where we're sitting right now. Now, another way to glean, you know, how far down can we go before this thing starts to find a bottom and starts to find a little bit of consolidation here. Where in this range will it go? And what's going to happen on Monday and Tuesday? I will say right now, any rally that we get should be considered a sell on the rally unless a couple of key things happen. For our members, I will go into a lot more detail in our Sunday night session. But for now, for all of our free subscribers out here this weekend, I would just consider any rally an attempt for you to, if you didn't get short right here, because a lot of people probably missed it. You can see that little channel that's forming. You can probably use that as a reason to pick up some shorts. So that's a little bit about where we're sitting right in this area right here, right now. But let me just show you a couple of other areas that where we can possibly find some support. And this is also good for all of you that understand. This is a good use of the Fibonacci as well, Fibonacci retracement. So I'm going to come up here and I'm going to click on my Fibonacci tool, and I'm just going to come down here, and then I'm just going to highlight right up here, right at the high. And once I click on it and lock it down, you can see the Fibonacci on here like this as I blow it up. Now, and again, we're on the daily chart, and I'm not going to go in. Sunday night, I'll go into the detail and minor nuances of this for our members. But if you look at where we're sitting here right now, you can see our upside resistance, initial upside resistance, which I'm going to call our R1 value, is right at about 2017.96. So call it 2018, okay, with this fib. And you can see, obviously, we're sitting right on the 50 EMA. The 200 EMA is sitting right on this tighter banded channel. And it's also sitting right on a 50% pullback, which is also like babies and candy, kids and candy. It's just price action is drawn to that. So, you know, in keeping this kind of trend, and the way we've got to make the assumption on this, I'm going to make the assumption that the markets are going to behave in a particular manner until I'm proven price action proves me wrong. So what's that manner? Well, just at a higher level here like this. And if I were to, and of course my lines aren't exactly straight, but I'm going to make the assumption that we're going to probably come up here, hit this tighter channel here, and again, we're a sell on any rally, and then we're going to come up, give it up, take out that prior pivot low, and come back down somewhere down in this area here, finding a little bit of support here, probably doing one of these kind of things, and then finding solid support in that area there. and every green bar that you see is going to be met by sellers. Now, this is a forecast. It's not guaranteed to happen, but taking us down there would also take us into closely to an oversold condition, and then possibly either a change in trend or a little bit of a chop until the markets determine what is the next direction. So near term, this is kind of how I'm seeing it. We could see Monday, we could see a little bit of a pop. So we've got a scenario Monday where we have a little bit of a rally, and then in the afternoon it sells back off again, and away we come back down to a lower part of the channel, or at noontime. Or we could have a rally and then it comes back down but doesn't really take out the prior low, and we're kind of stuck here. And then we have a little bit of this, and then it just gets choppy all the way down. Okay, a little bit more choppy instead of this tight pattern that we had right here. So that's one scenario. Another scenario that could very easily play out is at this point buyers do outnumber the sellers, and we start to get a buy on the dip mentality. And I'll go into detail again for our members Sunday on just what to look for. But should that happen, okay, should that happen on this channel down here, first we'll break the channel, all right, and then any sell-off will probably not take out a prior pivot low. We'll get some consolidation, and then we'll move up. We'll take out a couple of key levels, and then we'll have another pullback, but then it'll start a new channel like that. That's another scenario number 2. And then scenario number 3 is one where we just have chop through the end of this year. And if we get chop through the end of this year, then we're probably going to say in a tightly bound, if I were to divide this tighter channel into a median, and remember, we've been in the upper part of this channel for quite some time. I think through the end of the year, we'll be in this area right there. So we kind of come up and come down. We do one of these kind of things, and we're in this channel serving as support for us. And again, this channel is the tighter channel, right? Now, if I step out the make or break channel, that really we want to make sure that if the difference between this and all hell breaking loose is really we can hit it in a week. Now you can see right here the wider channel down in this area here. This wider channel that I remind you we've been in, and we've never really broken on a daily basis since 2009. Should this really turn into a contagion effect, and should this get a lot more draconian, you're going to see we take out the 200 EMA, which is this sitting right on this tighter channel, right? There's the tighter channel right there. Should we take out that 200 EMA, that means we take out the tighter channel, and now we come down and test this channel right here. You can see this blue line right there was the opening price of the SPX in January 2014. That puts us just a couple of measured points up above that. Again, we're still not oversold, so if it keeps on in this pattern, it's going to put us down in this area here, right? And should we break that, then it's just going to get very, very ugly. Okay, now one thing that does concern me, but I understand some of it, and for those of you out there that are trading interest rates or bonds, and I've always said you want to be able to follow the bond market because it really gives you a clue as to a risk-on, risk-off environment. And if we look at this bond market right here, it had a hell of a day on Friday, and if let's just go back to the beginning of 2014. You can see right here with the beginning of 2014, bonds have been up. Nobody in their right mind, including me, at the end of 2013, expected interest rates to actually go down. Everybody was expecting that interest rates with the Fed, they're going to start to tighten QE, or tighten stimulus rather, stop QE, which is the stimulus, and raise interest rates. And everybody thought bonds had made a high, and we're going to be working in a pattern that is a consolidated pattern to slightly down. Well, here is the channel with shaded zones on that channel for the entire year of 2014. This is January. In fact, the low was made January 2nd with the bonds. The high right now is up in this area here for the year in 2014. And every time we've challenged the lower part of this channel, only once did we break the channel, and the 200 EMA, which is this yellow line, served as support for it. And we're not oversold, overbought, and we're at the top of this channel. Now, I'll let you guys know, and again, with our members, I'll go into more detail. This is a tight R1 zone right here. It is a resistance zone for bonds, and we're right also at the top part of this channel. I suspect we're going to get a little bit of pullback here like that. So I took on some shorts towards the end of the day, or just rolled some of my shorts out in bonds to buy me more time duration. And we're also starting to see what I like down here as our members, as I like to call, a bearish divergence setup. So, you know, a possible trigger that could set that pullback off is we've got the FOMC, the Federal Operating Market Committee, meeting on Wednesday at 2 p.m. New York City time. They come out, or they meet Tuesday and Wednesday, but at Wednesday they make their announcements. Anything that suggests interest rate time frame is going to move up in time, you're going to see bonds pull back a pretty good bit. So I think the odds favor a pullback, not a break of the channel, but a pullback. So I'm playing mostly as we get to the top of this channel. I usually play pullbacks, and that's kind of the way I've been playing it. I'll admit this year I got in early here because I thought we were going to break it and come down here and then start to chop and then move down, but we didn't. We had this huge move up with the oil debacle, which we'll go into in a minute. Now, a lot of people will say, well, why in the heck have bonds been so strong this year when we've been making all-time highs in the equity market? It just does not make sense. And the big reason that oil has been making these highs is that money is coming in from Europe. Right now, the German bunds are like at about, I don't know, about 7, 8 or 0.8% interest rates on their bonds. Japan is, you know, like about 0.565%. Italy is, you know, at 1.2, 1.3. Our notes, our 10-year notes are at like 2.1. Our 30-year, you know, are at like 2.4 or 2.5, somewhere in there. So where would you rather put your money? Right there in a European government note, or right here in a U.S. government note? That's, you know, that's an easy question to answer. Of course you're going to put it here, you know, for 30 days, 60 days, 90 days, wait out some of this pullback. So we've had a lot of money coming in from Japan and coming from Europe into the U.S. securities. So that has also goosed our bond market, because in normal correlations, when you've got the government not interfering, you generally have equities up and bonds down with interest rates going up, and then it reaches a point where the yield in bonds becomes greater than some of the yields in stocks, and then money starts going back into bonds again, and it kind of keeps a cap on some of the growth in the equity market until the point where interest rates get too high, and then money gets sucked out of the equity market. Equity markets fall, and bonds, money just starts going in there in a greater fashion. So, but this is what's causing this anomaly right now, and it's just amazing to watch it happen. So, and this does create trade opportunities for us, which for our members, I spend a lot of time on and looking at. Now, one other chart I want to show you guys, and we'll look at one other thing here, which is oil, which is kind of the key for all of this mess a lot of people are seeing in the markets right now. The Russell, and if we look at the daily chart of the Russell here, we finally broke down. This is a key break, everybody. I mean, it's a key break. This is the Russell, and as you can see with this pattern here, you could probably call it a bull flag, right? I mean, it's a very wide pattern, but you can see here that, you know, here is the flag part, and here is the tight pattern right here. This blue line, by the way, was the opening price of the Russell futures in 2014. We finally broke it. and now we're underwater for 2014. We're sitting right on the 200 EMA and the 50 EMA. Let me just blow this up a little bit more to give you guys a little bit of a better perspective on this. So let me just kind of get this thing set here so I can blow it up a little bit more. If you look at this, you'll see that we've got a couple of things going on right here. Let's get it like this so we can see the full width of this. Number one, you can see that we've got the rut of the Russell futures actually came down and touched this yellow line, which is the 200 EMA. All right, I mean, it just actually made the touch. And the 50 EMA, it looks like, you remember we had the death cross right there, 50 below the 200. And then with this big, huge impulse move up, right, it looks like we're getting close to having the 50 cross back to the 200 again. And then we just, we stayed in this choppy range here, and then it finally gave it up. This is typical. The normal chart action calls for a break up here. That would be because, that was the direction of the movement prior to that choppiness there, and this is viewed as a consolidation period before a break to the upside. That didn't happen. We had this move down in this area right here. So now we got to say there's a lot of dry powder here. Where in the heck can this thing go? Again, we can use the Fibonacci to help us with this. And you can also see down here, we are nowhere near to being oversold. That tells me that we've got a long way to go should we break the 200 EMA and the 50 EMA, which is serving kind of as strong support. We break that, and it's just look out below because we're coming down, freight train ride. So we're on a couple of key support points here that can be very important for us. So where can we anticipate a little bit of resistance down below? Well, again, we use the Fibonacci, and I just come in here and I click on the low, and I come right back up, and I bring it up to the high, roughly, right in that area there. It's not exact, but you guys will get the idea. And then if I blow it up here, you can see right in this area here where we can expect or anticipate, should it break, where this thing can go, okay? And if we look at this, you can see that we've got a lot of support here, but then down below we got the 38.2% right at about, call it 1134. And then again, like I said in the S&P SPX, 1116 is going to be a strong point because that's the 50% area. It's a very common pullback point. We can stay in our bullish run, but those would be common support points that the market may find itself. Now, I would not be surprised if we do get a bounce on Monday, that we get a retest of this area right there. You can see the 23.6% fib area right there, which is near the opening price of the Russell at the beginning of the year, right? And because the Russell has underperformed all year. All the other indices are well north of their opening price. The rut has underperformed. I think in 2015 it'll be different, but for now, going into the end of the year, you can see that the price just gave it up very quickly. So we could get a little bit of a retest of this area and then a further pullback down like that. That could be a Tuesday, Wednesday event, seeing us down in that area. I'll go through with our members in detail. We're on a sell any rally type of mentality, but what could change that, even looking at the Russell? How could that change if we were to use the Russell to gauge? And we've been using the Russell as kind of a measure, like bonds with risk on and risk off, although bonds, because of all this money coming in from Europe and Japan, it's been a little bit more difficult measuring the risk on, risk off. There's a little bit of artificial nature to it compared to the other markets. Okay, so and then let's look at oil, because oil has just been just coming unglued, and it's starting to affect the other markets. Oil finished down over 4% on Friday. We're at 57.49. You can see we're way oversold in this area here. I mean, but this forecast, it can go a lot lower. Now, most of our members will know what I had forecasted way back when. And I'm just going to come out and show you guys, our free members, you know, what I was talking about. If I put it back on a weekly chart and I show you this symmetrical triangle here on this weekly chart, okay? Now, I didn't forecast this steep of a move this fast. No one would know that unless you're a Saudi and you know what you're doing in OPEC. And sometimes I don't even think they know what they're doing either. Although the Saudis are smarter and people give them credit for it. They know what they're doing. But generally when you got a symmetrical triangle like this, you got a 50% chance of a break up. You got a 50% chance of a breakdown. Now market awareness told me that the odds favor a breakdown. We've had such a long run in the equity market and the global economy is starting to slow down. Oil is a good precursor of where it sees global growth over the next couple of years. I said the odds favor a break there. Sure enough, once we had the break, that was a you know, time to go short kind of move. Now, I didn't expect this thing to fall down like it fell into a black star death hole, but that's what it did. The measuring objective for this move I had called somewhere down here around 50, and I said it may take a little bit of time to get there, and little did I know, again, this is a weekly chart, it would only take, you know, a couple of months, 2 or 3 months to get there. This move reminded me of another move I traded in oil back in 2008, which was the best move of my career. Riding oil futures from 148 down to about in the high 50s. Now, I could have stayed with it. Oil got down to $32. So don't make the assumption that oil has to go up. It doesn't. I'm going to spend time on the oil charts also Sunday night for our members so you guys get a really good play out of that one as well. Right now, I'm short oil futures. And I believe we may have a little bit of a bounce because a bounce is called for, but any rally in oil is going to be sold. That's just a little bit about kind of how I feel this is going to be. Any rally is going to be sold. But if we go back and look at 2008, there are a lot of similarities here in this move. All right, so if we just, let me just swing it back. This is the 2008 move here. Let's just zoom in a little bit so that you can see it. Now, the markets were different in 2008, so you can't draw the same conclusions. But I want to show you just what oil can do. This was 2008, right in this area here. And I went short oil up at the top up here. All right. And again, this is a weekly chart, so just keep in mind each bar represents, you know, a 5-day trading period. But if you look at the chart here, all of these huge down moves, and then there's an attempt at a rally. Now, it looks very small, but if you look at the rally from that point to that point right there, it's about $15 a barrel, right? So if you're trading it on an hourly basis or a daily basis, a move up of $15 seems like a lot. But in the scheme of things, it's not. It was sold hard down. And then another little bit of a rally here of about $10 a barrel. And then it was sold hard. And then a week where it kind of stayed constant, maybe up about $5. And then it started to give us this consolidation period down here. Actually came down over $33 a barrel. And then it slowly started working its way back up into that kind of channel like that. That's what's going to happen here. I don't call it down at the 33 area. I'm calling it somewhere around in this area right there, around $50 a barrel. Okay, that's kind of where I'm seeing it right now. Now, it could be a little bit lower, but once it gets there, folks, for those of you that have the capital to make the trade, I would highly encourage you to make the trade because this is the classic buy low and sell high. You can see where we are right now. If I were to just, let's move this out like this a little bit so we can put them on here at the same. You can see right in this area here, coming back here, and I just got to keep shifting this thing down, don't I? You can see now here's where we are right here. So we're not that far in the scheme of things from the bottom that were made in 2008. I think the market is different now than 2008. Remember, back in this time here, we did not even know if the banks were going to stay alive. So the whole financial system was in flux. In Europe, everything was coming unglued. But look at where we are right here. We're sitting right at that area there, right at that key support zone there, which is right in that key support zone in that area there. This is where we're sitting now. one final thrust down in that area there, which puts us at that key support zone right there, that key support zone right there. It's where I think we could go. And then we're going to start that steady climb up. We are extremely oversold. I mean, we're down to 12.27, so any move up can be expected. And remember what I said, over here we had move up from that low point to that high point right there is let's see, it's 110, 80, 90. So that's about almost a 30-point move right there, and then it just gave it right back up again. So we could literally move from 58 up to 70, you know, right up in that area there. Right up there, and then boom, give it back up again, right? And then come down to 50 very quickly, and then we kind of consolidate. So any upward movement here, I'm going to wait and sell on the rally unless I'm proven different. And there are a couple of areas, key areas here I'm looking for that if we take out, then I'll change my my analysis. But again, we had the break here, I had the call, and then I came out and said right about in that area there is where the measuring objectives would take us. And I got to admit, when I said it, I said, guys, this thing calls for a $50 barrel of oil. And again, this was back up when we were around $92 a barrel. And I said, you know, I just don't see the market here like right there. I don't see that, but that's what the price action's calling for. So that's the way we traded it. And for a number of our members, it was just a hellaciously great trade. So that's kind of where we're sitting right now. And I'm going to go into more detail on the oil market on Sunday again. So for our members, you'll be able to get a nice view out of that. And so what I'm going to do is I'm going to end this session just giving you guys an idea of, you know, what I said here with the E-minis. Anticipate maybe a possible bounce. We are in right now a sell on any rally mode. I'll go into the details on how that could change from a sell on a rally to a buy on a dip kind of mentality. For those of you that aren't members, I would highly encourage you to come on in. We're growing we're doubling our membership, you know, every year. And sometimes even more, and why? Because we're following the markets. We follow all excuse me, all the equity markets, the commodity markets, excuse me, the bond markets, and they tell a story. The currencies, we're in on currencies, playing the dollar long. I haven't even talked about the currencies in this weekly update, but we'll go into details on these Sunday night. If you're not a member, I highly encourage you to come in, check out our special offers. And come on in and join us. You'll get into our chat room. We meet every day in our chat room. And we also have the Tuesday, Thursday morning sessions before the market, and then Sunday night sessions for the upcoming week. All right, everybody, I want you all to have a really great weekend. Enjoy yourself. Members, I will talk to you guys tomorrow night, 8 p.m. New York City time. Have a good one, everybody. Bye now.